The first one is Telkomdigi Berhad. It is Malaysia's largest mobile network operator with more than 20.4 million users on its network. The company aims to serve the growing digital need of its customer by innovative range of digital product and service. The goal and function of financial management are maximize shareholder wealth and long-term value. Next is risk management. Telkomdigi and other telecom company has faced the same problem, which is technology risk like network upgrade costs. The second one is Maxis. Maxis is a mobile communication service in Malaysia. It is operated in three segments, which is mobile service, fixed line service, and international gateway service. The goal and function of financial management same with Telkomdigi, which is to maximize shareholder value. To balance cost efficiency and service quality, Maxis has to control their operational costs while delivering high quality net. I will continue with the financial structure and performance analysis. The first one is the current ratio, which is to measure a company's ability to pay its short-term obligation using its short-term asset. Current ratio for Telkomdigi for 5 years is all below 1. This shows that this company is having a problem covering their current liabilities with current asset. 2020 is the best year for Telkomdigi, which is the current ratio is 0.34. It is getting worse in 2023 and 2024 because the ratio fall in the very low level. This shows that this company depends on borrowing to meet its obligation. On the other hand, Maxis has a very high current ratio. This means that Maxis has enough current asset to cover their debt. This company performed best in 2024, which is 186.5. However, the high ratio shows that Maxis hold too much cash. Overall, Maxis consistently has much stronger current ratio than Telkomdigi Berhad. While Maxis maintain a strong short-term financial position, Telkomdigi face a liquidity challenge. Next is quick ratio. It is to measure a company's short-term liquidity than current ratio. Telkomdigi has a quick ratio below 1 in all 5 years. This shows that this company doesn't have sufficient liquid asset to meet their liabilities. 2020 is the best year for Telkomdigi, but the ratio is still weak comparing to Maxis. The ratio dropped in the following year and continue getting worse in the 2023 and 2024. This makes Telkomdigi face a serious problem and they have to depend on external financing. In contrast, Maxis has a high quick ratio in all 5 years that show this company has an ability to pay their short-term liabilities. In 2024 is the best year for Maxis because the quick ratio reached its highest level, which is 186.5. This means that Maxis is having no problem in meeting the short-term obligation. Based on this quick analysis of Telkomdigi and Maxis in 5 years, I can tell that Maxis is outperforming Telkomdigi in terms of short-term liquidity.
Next, I will explain profitability ratio. This section analyzes the profitability performance of Telkomdigi and Maxis from 2020 to 2024, aims to evaluate the company's ability to generate profit and maintain financial efficiency. We use three profitability ratio, which is net profit margin, return on asset, and return on equity. Ratio are calculated based on data from the company's annual report. First, net profit margin. How to calculate this? Net income divided by sales. For Telkomdigi, NPM declined from 19.84% in 2020 to 10.96% in 2024. Slight rebound in 2023, 11.28% to 12.36%, likely due to better cost control or revenue growth. For the Maxis, NPM fell from 2020 to 2023, then improved to 2024, which is 13.25%, shows more stable performance reflecting gradual improvement in operational efficiency. For the key takeaways, Telkomdigi achieved higher profitability per revenue but is more volatile. For Maxis, demonstrates steadier margin, highlighting the importance of cost and operational management in telecom. Next, return on asset. For Telkomdigi, achieved very high return on asset in 2020 to 2021 and dropped sharply in 2022 due to a significant increase in total asset. Return on assets stabilized at around 4% in 2023 to 2024. For Maxis, small decline from 6.30% in 2020 to 4.35% in 2023 and increased to 6.25% in 2024, indicating consistent utilization of asset to generate profit. For the key takeaway, Maxis used its asset more efficiency and cost consistently over time while CelcomDigi asset efficiency and varied significantly. Next, return on equity. CelcomDigi recorded extremely high return on equity in 2020 to 2021, and sharp drop occurred in 2022 likely due to a large increase in equity, and recovered slightly in 2023 to 2024 but remained lower than yearly years. For Maxis, maintain a steady return on equity ranging from 17.27% to 24%, and decreased slightly from 19.60% in 2020 to 17.27% in 2023, rebounded to 24% in 2024, reflecting stronger returns to shareholder due to stable net profit and equity management. For the key takeaway, Maxis show stronger and more stable returns for shareholder, highlighting consistent financial performance while CelcomDigi was more volatile.
Next, I will explain about the leverage ratios. Leverage ratios are financial ratios used to measure how much a company relies on debt to its finance, its asset, and also operations. When a company have a high leverage, it have more debt and also higher financial risk. If the company have a low leverage, it means it have a less debt and also more financial stability, but possibly slower growth. Based on the debt to equity ratio from 2020 to 2024, CelcomDigi showed a strong improvement, which is dropping sharply from a very high debt equity, which is 12.51 in 2020 to around 1.21 to 1.22 in 2023 until 2024. It's indicating much lower reliance on debt, while Maxis ratio increased steadily from 2.11 in 2020 to 2.97 in 2023 and remained relatively high at 2.78 in 2024, which showing continued higher debt dependence over the 5 years period. In conclusion, CelcomDigi shows a stronger financial position and Maxis maintain higher debt levels over 5 years. Next, for the debt ratio from 2020 to 2024, CelcomDigi showed better performance by reducing its debt significantly from a very high debt ratio, which is 93% in 2020, to a stable and lower level of 55% in 2023 until 2024. It's indicating lower financial risk, while Maxis debt ratio increased from 68% in 2020 to 75% in 2023 and remained high in 74% in 2024, is showing that Maxis continued reliance on debt and higher financial risk compared to CelcomDigi. In conclusion, CelcomDigi have a better performance in reducing debt and improving financial stability, while Maxis maintain high debt levels and face higher financial risk over the 5 years. Lastly, for the interest coverage ratio from 2020 to 2024, CelcomDigi initially increased from 7.1 in 2020 to 8.2 in 2021, and then declined steadily in 3.8 in 2024, is showing better debt management and a lower interest burden, while Maxis interest coverage fluctuated between 4.7 and 5.1 with no clear downward trend and indicating more unstable interest costs. In conclusion, CelcomDigi showed stronger and more consistent improvement, and Maxis experienced fluctuating interest costs over the 5 years.
Next, I will continue with the market ratios. Market ratios are financial metrics used to relate a company's financial performance to its stock market performance. In this section, the analysis focuses on 3 key market ratios, which are earnings per value, price to earnings, and dividend yield. The purpose of this analysis is to compare the financial performance of 2 listed companies, which is CelcomDigi Berhad and Maxis Berhad. Graph used in this section is clearly illustrate and compare the difference in market performance between 2 companies over the 5-year period. So next, earnings per share measures a company's profitability by showing the profit allocated to each share. CelcomDigi's EPS declined from 15.7 ringgit per share in 2020 to 10.4 ringgit per share in 2022, recovered to 13.2 ringgit per share in 2023 and fell to 11.7 in 2024. However, Maxis declined from 11.7 per share in 2020 to 12.7 per share in 2023 before recovering to 17.8 ringgit per share in 2024. Overall, Maxis consistently shows higher EPS than CelcomDigi, indicating stronger profitability per share. Price to earnings ratio measures how much investors are willing to pay for each ringgit of profit, indicating expected growth. CelcomDigi PE rise from 0.26 times in 2020 to 0.38 times in 2022 and remains stable at 0.31 times in 2023 to 2024. Maxis fluctuated between 0.28 times in 2020 and 0.21 times in 2024, which is this showing less stability. Overall, CelcomDigi maintained a higher and more stable price to earning ratio than Maxis, suggesting stronger investor confidence in its growth. Dividend yield shows the return investor receive from dividends relative to the share price. Celcom DG yield declined from 3.77% in 2020 to 3.05% in 2022, then increased to 3.95% in 2024, which offering more stable but lower returns. Maxis yield increased from 3.38% in 2020 to 5.21% in 2022, dropped to 4.16% in 2023 and recovered to 4.66% in 2024, providing higher but more fluctuating returns. Overall, Maxis offer higher dividend returns, while Celcom DG provides more stable yields.
This slide explains the working capital management of Celcom and Maxis. Both companies operate in the telecommunication industry, which requires high operating costs and continuous cash flows to support daily operation and network expansion. Their working capital management focus on maintaining sufficient cash to ensure smooth operation, managing receivable from postpaid and corporate customers, and controlling inventory such as SIM card, devices, and network equipment. In addition, strong liquidity is important for both companies to maintain service quality, meet short-term obligation, and support long-term business growth. This slide compares the working capital management of Celcom DG and Maxis. In terms of cash management, both companies maintain strong cash position. Celcom DG focuses on supporting operation and network expansion after the merger, while Maxis benefits from more stable and consistent cash flows. For inventory, both companies mainly manage SIM card, devices, and network equipment. Effective inventory control helps reduce holding costs and support efficient service delivery. Regarding receivables, Celcom DG manage a large base for postpaid and corporate customer, whereas Maxis generally experience faster collection due to its premium customer segment. Overall, both companies show strong liquidity, which allows them to maintain service quality, invest in infrastructure, and may remain competitive. This highlights the importance of effective working capital management in ensuring strong business performance in the telecommunication industry.